Welcome back. A lot of turbulence has hit NBFC, housing finance and banking space this fiscal. Banks first underperformed on higher deposit cost, fear of lower margins. Now NBFCs also suffered initially due to higher cost of borrowings, but they have recovered very smartly. MFIs, microfinance lenders and small finance banks were also largely microfinance, have suffered from higher defaults due to overlending. Only housing finance companies in this entire space have surged and surged as they got a boost from the mega listing of Bajaj Housing. Now, where do these various BFSI segments stand today? I have with me someone who watches all this very carefully, Suresh Ganapathy of Macquarie, to give us an idea of where are the trouble spots and where do we still find value. Good morning, Suresh, and thank you very much for sparing time for us. Well, I have actually a very fundamental question on Bajaj Housing, which has ignited so much excitement in the otherwise ignored area of housing finance. Why would HDFC close down if housing finance is really so lucrative? I still can't make my peace with that question.
You have to understand, Latha, that scale matters here, right? HDFC closed down at a scale size of 6-7 trillion rupees. So Bajaj Housing Finance is far away from that. I'm pretty sure when they reach that kind of a scale and size, sustaining the current level of profitability will be very difficult. You also have to understand that almost 50% of the book for Bajaj Housing Finance comes from non-pure mortgage, which is basically loan against property, construction financing, and other kind of segments which are very high yielding. The core mortgage business doesn't yield that much kind of an ROA. So eventually, when you are going to go to a 6-7 trillion rupees, it's tough to run a 3.5 trillion rupees of a non-mortgage book, right? So those challenges Bajaj Housing Finance will face, in my opinion. It's just a matter of time. It's just because today they are smaller, they're able to sustain some of these growth metrics as well as profitability metrics.
Yeah, I just wanted that point on the table, that someday scale will hit, but they are a distance. They're hardly 1 trillion book, and perhaps these problems will rise only when you're 6 trillion. But you made another point about the whole housing finance, mortgage lending itself being a low margin business. And yet all those companies are doing very well. Aptus, for one, is, of course, up and away with, I think, a 4 times book or even over a 4 times book. Is there any interest for you in that space otherwise?
Yeah, look, Latha, I think when I said mortgage finance being a low margin and a low ROA business, I meant the usual, the average ticket size being around 40 lakhs or 50 lakhs, right? You're talking about the mass market housing. Where exactly the niches are basically is in the affordable housing finance, where you're largely lending to smaller ticket size segments where banks don't compete, and also largely to self-employed guys. And many of this lending is basically to construct your own houses on your land, right? So that's one segment where clearly the yields are also higher. You can get 14-15% yield and you're able to make that kind of an ROA. Again, to reiterate the point, it's only up to a certain scale and size you can build an affordable housing finance book, beyond which obviously you'll have to venture into the mass market housing. Guys like ours or Home First and all these guys obviously currently are pretty small at this point in time, and therefore they're able to get outsized returns and therefore a higher ROA and eventually higher valuations. Eventually, scale will be one of the biggest inhibiting factors for profitability in our view in the longer term for any housing finance company.
Okay. Well, I would assume Aptus and all are very far away from that area. So perhaps good buys now. Suresh, let me come to the bigger question of cost of funds. I think now it's a 3 or 4 month old debate or even longer on the cost of deposits for banks. Now, technically, that should hit NBFCs as well, right? Although NBFCs have started borrowing much more from the market, there is still a cost issue between banks and NBFCs. Where would your preference lie at this point?
Yeah, so if you were to really look at from the near-term results standpoint, you'll continue to see greater degree of margin pressures or perhaps slowdown for the NBFC space. If I were to really look at the second quarter numbers, there is obviously, as you know, stress in certain select pockets, be it on the credit card side, certain categories of course, personal loans. And of course, we also know, the over-leveraging in the microfinance space, which is happening. But, as you know, Latha, markets are always forward-looking, right? So while we know that the next quarter or couple of quarters will be a little bit more challenging, The fact that, the last couple of months liquidity situation is definitely eased quite a bit, right? If you look at the banks parking surplus money with the Reserve Bank of India, and the government spending, of course, actually picking up. You have call money rates hovering continuously below repo rates. The 10-year bond yields are
Yes.
now down to 6.8%. So as you know, as you rightly said, that more amount of money is being borrowed from bond markets to take advantage of the fall in bond yields. All that takes time to play into the numbers for the NBFC space. Also note that during this time, of course, Fed has already cut the rates. You're likely to see the Reserve Bank of India also cutting rates, albeit maybe only 50 basis points. But that also will start flowing through, and there will be a change in narrative or stance from the Reserve Bank of India. That's good for the NBFCs because I think the first leg of the rally will happen more in multiple expansion, which you already saw to some extent in the NBFC space. And later on, you slightly see that seeping into the fundamentals. But the actual improvement is at least 6 to 9 months away. The next 3 to 6 months will still remain a bit more subdued for them.
Okay, so you're saying that when the rate cut cycle starts, and there are a goodish number of economists who are expecting the rate cut in December,
Yeah.
probably a little dovishness in the October policy and a rate cut in December. I don't know how
Yeah.
correct they're all. But if that were to happen, you think the first line of beneficiaries are the NBFCs.
Definitely,
For the
yes.
banks, initially, it will be a negative on their margins.
That's right. We also did an analysis where we did the last three Fed rate cut scenario in 2001, I think 8 and 2019. And what we found was that the only sector in India which actually did very well in each of those rate cut cycles in the near term, what I meant is in the next 3 months or 6 months during the Fed rate cut cycle was NBFCs, right? So,
Okay.
I mean, of course, these are all correlations and in analysis, but nevertheless, that's something which we need to keep a note of. Yeah.
No, I take your point. We are already at 6.76 on the 10-year, and Indian rate cut, as well as more cuts from the Fed. If the US 10-year were to go below 3.5, we should have a concomitant fall in Indian yields as well. So I take your point on that. Okay, let me come to the other. Okay, just to finish the cost of deposits problem, what is
Yeah.
your best guess on when the banks will see an easing of their deposit problem? I mean, it is caused by HDFC having to cover up for the HDFC merger, as well as other reasons,
Yeah.
like the government spending wasn't good enough in the first 3 months, etc.
Yeah.
When do you see this peaking off?
Yeah. So if you actually look at the latest data from the Reserve Bank of India, that is still showing an upward trajectory on weighted average term deposit rates, right? And
Yes.
weighted average lending rates. So
Yes.
that Latha will continue for another, I would say, a month or so, a couple of months. So the way we are looking at it is I look at it this way. The last couple of months, liquidity situation has become better. You're likely to see, or you have actually already seen credit growth having come down from 16 to 14%. Not many people are aware, and it's not being talked about much. The incremental loan to deposit ratio this financial year till date, I'm taking March 22nd as a reference point, is only 60%, right? So the outstanding number is 79, but the incremental is already down to 60%, which means all the actions taken by the regulator is playing out in terms of lower growth, lower incremental loan to deposit ratios, which actually means that coinciding with the rate cut, which perhaps can happen from December, I would say we are likely to see around that period slight easing of deposit rates, if not easing, very clearly peaking of all the rates in the system. You know what happens? Tricky part here is the October to November is a festive period. Coupled
Yeah.
with that, Jan to March is a seasonally very tight period. So I don't think we are likely to see any kind of cuts happening by March. Maybe post March is the time when you are actually likely to see an effective cut in the deposit rates. But till that time, considering where we are entering into busy festive period coupled with a tight seasonally fourth quarter, don't think any cut in rates will happen.
Okay. Well, I
That's
must
why it
point out.
doesn't. That's
Yeah.
why it didn't make any sense for RBI to even cut rates because it is not going to transmit in the form of a lower rates in the system, right? So that's how we should look at it. Yeah.
Okay. So the cut in deposits might come, say, in the June quarter, is what you're saying.
Yes. Yes.
Okay.
April to June
Okay.
quarter. Yeah.
Fair enough. So we have to grin and bear it for 3 quarters as far as the banks are concerned. And now finally to come to asset quality. We know that there has been an MFI issue. And, the credit cost advantage that banks had, the very, very low credit cost, that also is running out. So do you, if you compare, where do you see the asset quality pressures coming in first?
Yeah. Look, I think, Latha, the way you should look at it is which banks have what exposure to the different kind of segments here, because it's too difficult to generalize at this point in time that say all these private sector banks or all these PSUs or all these NBFCs are going to face an issue, because the stress today, A, is granular in nature and it is concentrated in certain pockets. For example, the credit card still stress is still real. We have been speaking to some of the bank managements, and the net credit losses that some of the banks are running in the credit cards portfolio is anywhere between 5 to 6%. But that's not a great number to look at, right? And MFI, of course, you know about the over leveraging which is happening, and of course certain categories of personal loans. So I guess clearly those institutions which are exposed to these kind of subsegments will be at a greater risk. But again, none of this risk is debilitating on the balance sheet of the institution and also the broader systemic level. So, in that sense, at a system level, things are fine. But at an individual stock level, the problems could be more. So, for example, will I be cautious about taking exposure to microfinance lenders? The answer is yes. Will I be cautious in taking exposure to credit card lender at this point in time? The answer is yes.
Okay. So that's why I think your best stock is Shriram Finance, because it's far away from both these kinds of loans. That's
Yeah.
what's your NBFC pecking order?
Yeah, so actually, I also like the housing finance companies. I mean, if
Okay, sure.
Housing Finance is getting 6 times price to book, I'm pretty sure all the other housing finance companies which are closer to that level of ROA should at least get half of what Bajaj Housing Finance is getting. I understand growth is, of course,
So LIC
another
Housing?
differentiating factor. Yeah, LIC Housing Finance we do like.
Okay.
So then we can also look at, as I said, Shriram Finance. We also like AB Capital, one of the newer stocks that we initiated. Again, it's in the consumer lending space, but they have run down their unsecured portfolio, and SME lending is a bigger component in their overall piece. So yes, selectively, it's high time that we look at some of these NBFCs.
Okay. Now, as coming to the banks, at the moment, everyone's best buy would be ICICI Bank. And then, of course, HDFC Bank has fallen lower in the order. And after SBI's latest credit cost increase in the last quarter, even that's gone down the ranking. Once the hump of deposits is over, 1 year down in June, what may the ranking look like?
Yeah, look, I think if you're calling for falling rate cycle to some extent, maybe IndusInd Bank fits the bill. It has the largest proportion of fixed rate portfolio. HDFC Bank has an NBFC in itself, right, which is about 25% of the balance sheet, which is HDFC Limited. So you're talking about easing liquidity conditions. That also fits the bill. I thought another important point which I should make to the viewers at this point in time is the Reserve Bank of India at the margin is getting what should I say, a little bit more relaxed or comfortable, right?
Kinder.
Because yeah, kinda. Yeah, okay, that's a better word to be used, Latha, because if you look at it, all the desired outcomes have been achieved, right? Be it in terms of lower loan growth, they are going to do something on LCR and ECL stuff. Unsecured loan growth is down, and look at some of the actions that have been taken. They have completely given back the gold loan financing ability to India Infoline. They have also given IndusInd Bank an AMC license, which is unthinkable considering the fact that they really don't want parabanking activities to be done under a banking
Yep.
umbrella and depositors taking the hit, right? So if that indeed is the approach, I think it's a great time to relook at the banking space more.
Okay, just a final question on HDFC Bank. Something that slipped my mind and you brought up with HDB about to be listed.
Yeah.
How does that change the valuation? After all, the sky-high valuations of Bajaj Housing also brought some more buying to Bajaj Finance.
Yeah. Here is where I think HDFC Bank gets a little bit more unfortunate, because the contribution of HDB Financial Services to the overall valuation is pretty limited, because HDFC Bank itself has so much of market cap that, and I know, and every analyst values at $5-6 billion HDB, even if it gets listed double, where you're talking about $150 billion valuation versus another $5 billion valuation that the market is willing to give, right? So it doesn't move the needle. And there are other subsidiaries which also have a great value. So in that sense, HDB listing, while of course it is sentiment positive, it doesn't really move the valuations for HDFC Bank in a big way, unlike for Bajaj Finance and Bajaj Housing.
Fair enough. Thank you very much. It was a bhelpuri of questions on various aspects, but thank you very much for leaving us that much the wiser on banking, NBFCs, housing finance, and MFIs. Thank you very much, Suresh Ganapathy. We have to take a break on that note. Chartbusters coming.